Hello everyone, I am Kavya. I am studying MBA first year second sem in Sri Venkateswara College of Engineering, Bangalore. Today I am going to explain about the options. First, let us know about the introduction of options. Options are financial derivatives that give the holder the right, but not obligation, to buy or sell an underlying asset at a predetermined price. They are widely used for hedging speculation and enhancing portfolio returns. Understanding options is crucial for investors seeking to manage risk and leverage market opportunities. First, let us know about the what is options. Contract that give the holder the option to buy or sell specified quantity of underlying asset at a particular price on or before the specified time period. The word option means that the holder has the right but not the obligation to buy or sell underlying asset. Let us know about the types of options. The two primary types of options are call options and put options. Call options provide the right to buy an asset, while put options grant the right to sell an asset. Each type serves different strategic purposes in financial management and investing strategy. Options are financial derivatives that give buyers the right, but not the obligation to buy or sell an underlying asset at an agreed upon price and date. Call options or put options form the basis of a wide range of option strategies designed for hedging income or speculation. Options trading can be used for both hedging and speculation, with strategies ranging from simple to complex. Although there are many opportunities to profit with options, investors should carefully weigh the risk. Options are versatile financial products. These contracts involve a buyer and seller where the buyer pays a premium for the rights granted by contract. Call options allow the holder to buy the asset at a stated price within a specified time frame. Put options, on the other hand, allow the holder to sell the asset at a stated price within a specific time frame. Each call options has a bullish buyer and the bearish seller, while put option have a bearish buyer and the bullish seller. Traders and investors buy and sell options for several reasons. Option speculation allow a trader to hold a leveraged position in an asset at a lower cost than buying shares of the asset. Of options, call option. A call option gives a holder the right but not the obligation to buy the underlying security at a strike price on or before expiration. A call option will become more valuable as the underlying securities rises in price. Calls have a positive delta. A long call can be used to speculate on the price of the underlying rising since it has unlimited upside potential, but the maximum loss is the premium paid for the option. In put option, opposite to call option, a put gives the holder the right but not obligation to instead sell the underlying stock at the strike price on or before expiration. A long put, therefore, is a short position in the underlying security, since put gain value as the underlying price falls. Protective puts can be purchased as a sort of insurance, providing a price floor for investors to hedge their position. Key terms in options trading. Important terms include strike price, expiration date, and premium. The strike price is the price at which the underlying asset can be bought or sold. Premium is the price paid to purchase the option, reflecting its intrinsic and extrinsic value. How options work? Options are traded on various underlying assets, including stock commodities. They can be executed at expiration or before, depending on the type of option, the market and market conditions. The value of options fluctuates based on the factors like underlying assets price, time decay, and volatility. Benefits of using options. Options provide flexibility in investment strategies, allowing for various approaches to risk management. They can enhance returns by leveraging capital and enabling investors to control larger positions with less money. Options can also be used to hedge against potential losses in underlying investments, reducing overall portfolio risk. Benefits and disadvantages of buying put options. Put options are investments where the buyer believes the underlying stock market price will fall below the strike price on or before the expiration date of the option. Once again, the holder can sell shares without the obligation to sell at the stated strike price share price by the stated date. Since buyers of put option want to stock price to decrease, but put option is profitable when the underlying stock's price is below the strike price. If the prevailing market price is less than the strike price at expiry, the investor can exercise put selling put options. Selling put options is also known as writing a contract. A put option writer believes that the underlying stock's price will stay the same or increase over the life of the option, making them bullish on the shares. Where here, the option buyers has the right to make a seller buy shares of the underlying asset at a strike price on expiry. The main advantage of options are options can be very useful as a source of leverage and the risk hedging. For example, bullish investor who wishes to invest 1000 in a company could potentially earn a far greater return by the purchasing 1000 worth of call options on that firm as compared to buyers 1000 of that company's shares. In the call options provide the investor with a way to leverage their position by increasing their buying power. On the other hand, if the same investor already has exposure to that same company and wants to reduce that exposure, they could hedge their risk by selling put options against that company. The disadvantage of options. The main disadvantage of option contract is that they are complex and difficult to price. This is why options are considered to be security most suitable for experienced professionals investors. In recent years, they have become increasingly popular among retail investors because of their capacity of outsized return or losses. Investors should make sure they fully understand the potential implications before entering into options positions. Failing to do so can lead to devastating losses. How do the options differ from futures? Both option and futures are types of derivatives contracts that are based on some underlying asset or security. The main difference is that the option contracts grant the right but not the obligation to buy or sell underlying in the future. Risk associated with options are trading option involve significant risk, particularly due to their complexity and potential for substantial losses. Both buyers and seller of options face unique risk that must be understood before engaging in option trading. It's essential for investors to have a clear risk management strategy when incorporating options into their portfolios. Option strategies. Various strategies can be employed, including covered calls, protect, protective puts, and spreads. These strategies allow investors to tailor their exposure based on market conditions and personal risk tolerance. Understanding the intricacies of these strategies can lead to improved financial outcomes and better risk management. Conclusion. Options play a vital role in modern financial markets and are increasingly popular among investors. As markets evolve, the use of options is likely to expand. Continuous education and adaptability. Staying informed about changes in regulations and market dynamics is essential for successful option trading. Thank you. Thank you for watching.